Good evening, everyone, and welcome to this special ePlanet Academy webinar. It's great to have you all here as we dive into a truly valuable discussion on trading success, what it takes, the challenges traders face, and how to build a lasting edge in the markets. At ePlanet Academy, we're committed to providing real education from the best minds in the industry. And today, we're honored to host someone who has made a lasting impact in the world of trading, Adam Grymes. Mr. Grymes is a highly respected trader, author, and educator with decades of experience across financial markets. He started his journey as a retail trader before moving into institutional roles, giving him a unique perspective on how markets operate at every level. He's the author of The Art and Science of Technical Analysis, a book that has become essential reading for serious traders, and he has worked extensively in market research and trader development. What truly sets Adam apart is his ability to bridge the gap between technical analysis, market structure, and trading psychology, helping traders not only build strong strategies, but also develop the mindset required for long-term success. His insights have guided countless traders, and today he's here to share his expertise with us. So without further ado, let's welcome Adam Grymes to ePlanet Academy. Hello, Mr. Grymes. It's an absolute honor to have you here with us at ePlanet Academy. Thank you for joining us, and thank you for being here.
Thank you. The honor is mine.
All right. A lot of traders, many internationally and even in Iran, know you from your work in the art and from the book, The Art and Science of Technical Analysis, or they have read your blogs or different type of online educational contributions. But for those who are less familiar with your work, could you please tell us about yourself, about your fascinating journey as a trader and also as a mentor? What have you gone through to be here today as a market expert?
Sure. Well, thank you. So I've gone through a lot. I started trading in the mid-1990s. And one of the things that I like to tell people is wherever you are, wherever you're starting, you can be successful. It's not possible. I firmly believe this. It's not possible for somebody to know less than I did when you start. I graduated from college. I had a degree in music, and I got what turned out to be a scam flyer in the mail that promised to teach me how to make riches by cornering the market in cattle futures. And I was interested. I thought, let's see what's into this. I kind of guessed that the method that was being explained would not actually work. But I went through the process of opening several small accounts. And again, I knew nothing. I was paying, just for numbers, the account for maybe $2,000 US. This was in the mid-1990s. And I was paying in commission $100 a round turn. So right away, even before there's any, P&L, I'm very deeply in the hole. And I was trading full-size futures contracts. So many of those accounts, 2 or 3 trades, and the account was destroyed. And I went through that process for a while and lost money very quickly and experienced the pain of losing money, and also experienced the emotions of trading, which really surprised me because I thought, we're talking about psychology among other things today, but I had a background as a performing musician.
Wow.
And one of the things that was a little bit unusual about me was I just didn't get stage fright in any situation, whether performing in public or competitions. And I had read that when people started trading, they had all these emotions. I thought, well, it won't happen to me, because I don't get stage fright. I'm not going to have that emotion. And in fact, I put on my first trade, and I didn't know. I never encountered these emotions. I didn't know what was happening. My heart was racing. I was sweating. I had to go to the bathroom like 5 times in 10 minutes. It was just my body was doing things I didn't understand. And I was so clueless, I didn't even realize, oh, these are trading emotions. And so, I experienced a little bit of the emotional roller coaster. And after the dust settled and I had destroyed a few accounts, I realized a few things, that there was something about this I really liked. There was something that was really fascinating about how the market moved. It wasn't even, at that point, it wasn't even about money for me. It wasn't a way to get rich. It was, I was willing to kind of push that aside, and I was really interested in solving the market puzzle. And I was emailing a lot of people, a lot of big names, a lot of kind of the old classic people who design technical indicators and the trading systems. And I got some really amazing replies. Some of these people really corrected a lot of my misconceptions. And as things progressed and I continued experimenting with different ways of trading, I got into day trading, and this was a very different world, let me tell you. This was, so now we're headed toward the late 1990s. I had, and I know many of your viewers will not even know what I'm talking about, but I had a dial-up modem. So that meant nobody else could be
Oh, we
on the
know
phone.
what a dial-up
Yeah.
modem
Oh,
is.
do you in your part of the world, is that still a thing? And so nobody else can be on the phone, and I was day trading, and this was before electronic executions. So I had to have two phone lines, and I would call in orders to the floor while I was watching data on my dial-up modem, and of course, which is not extremely fast, right? And many times I would have to get out of trades before I got the confirmation from those. So I did learn that accounting was very important, because I still had a pretty small account, and I had to keep track of my position. And I was fortunate to be trading the British pound. The first money that I made was in British pound futures. And this was during a time when that market kind of went crazy. And I don't think I really knew much about the market, but I corrected a lot of mistakes. I think there's a lesson there. One of the first things you can do as a developing trader is learn how to stop hurting yourself, learn how to stop making a lot of the typical mistakes that traders make. And I made what for me was a very nice amount of money. And I took a little bit of time off from trading, and I pursued professional cooking. I have a lot of other
Wow.
interests. I did served an apprenticeship with a French chef here in America and learned a lot about the classic French cooking. And then shortly after some of you may know market history, there was this .com crash in the 2000s. And I kind of missed that whole run up, which in retrospect, I think was a very lucky thing. I think one of the most challenging things that can happen to developing traders is you get lucky and you make a lot of money early on. And I know many, many people who made a lot of money in the late 1990s trading tech stocks and then lost it all. Or, we're not able certainly to make any more money. So I actually came back on the scene. I missed a few years there. I came back on the scene when the market was beginning to crash, and I started trading S&P futures, day trading. So, by this point, I'd learned a lot more, and I was trading 1 and 5 minute charts. I was a very short-term trader. And that continued for a while. I transitioned to longer-term swing trading. We can talk about these transitions if you want, but I will say that every transition is difficult. It was very difficult for me. It's not like you know how to trade and you're invincible in all markets. You know how to trade, but then for various reasons, it's not so easy to jump to a different asset. Or I got an MBA, started trading stocks, spent some time on the New York Mercantile Exchange, worked for some prop firms in New York City, also worked for some hedge funds, and then spent a lot of time after about 2010 focusing mainly on institutional advisory. So the way I like to explain this is, I was an advisor to advisors, people who managed a lot of money and sometimes billions of dollars, would look at my technical work for insights or to know how to apply options to what they were doing. And then in, I think about 2018, 2019, started really focusing on doing work with retail traders, basically, with people with that. And, this ranges from, people who are still in school, who have just a little bit of money to trade, to people who've retired, have a lot of money to trade. And that's really my focus is today is on, giving those people my best insights into what's happening in the market and to understand the probabilities, what it takes to be profitable. And along the way, I've also done a lot of individual training and teaching, and this work is really showed me a lot about how to teach and how to trade and the challenges of trading. So I guess that's not a short resume, but that's kind of my career sketch.
Thank you so much for taking us through that roller coaster. I'm sure a lot of people who heard about your experiences felt it resonated with them, whatever that you experienced, especially as a retail trader, as a day trader, a scalper. I was aware that you were professionally in music, classical music, but I didn't know you cooked professionally as well. It was a big surprise. I just wanted to ask you another question before we dive into the main topic of today's webinar. So because of your rare opportunity of going through a lot of different stages as a market participant, as a trader, I'm sure you have seen different aspects of the financial market. How has your perspective changed over the few years? I'm sure you're not the same person as you started. And how did this journey shape the way that you understand the financial markets?
So you're right. I started at home with a chart book that came in the mail. I didn't even have charts on the computer. And I have been on the inside of market making algorithms. So, I know what happens at that degree. I have done and have advised a lot of algorithmic and systematic traders. And I've worked a lot with discretionary traders. So I've seen across the board. And I guess one thing that has really surprised me is, it doesn't anymore, but when I encounter people who are very successful, who have made a lot of money or built big businesses in some aspect of the market, they ask a lot of questions. And sometimes they ask a lot of questions that are the same kinds of questions that I'm asking. So what I've realized is that nobody has the big picture. And people build these areas of specialization, and they understand their universe, they understand how the market moves that's relevant to them, but there's still a lot of undiscovered country, and there's still, the very, very curious minds, and this is one of the contradictions in trading, because as we're going to talk about, the way you get successful in trading is you do one thing over and over, and you really do specialize. You learn a certain area. However, I just told you that the people with kind of questing, reaching minds tend to be successful. So, and certainly, from my background with, and we haven't even covered the extensive craziness with some of the hobbies that I've been into. What I have found that as I need to keep a very clear focus on the market, and I need to have other ways to satisfy my intellectual curiosity outside of the market. But I guess maybe the most relevant thing is there's this big debate about the market being manipulated. And it shouldn't be a debate, because the market absolutely is manipulated. Now, I think the market's manipulated always. I don't think it's manipulated. There's some very silly things that are set out there on the internet. There are people who have built businesses like saying there are these magic algorithms that move currencies around it. Like that's just not, as far as I can see, that doesn't seem to be true. But there certainly are people who have information that we don't have. And there are very, very big traders who at any point in time can decide to do something. So many times for things that might not have anything to do with the market. One of my jobs, I worked as an execution trader for a very big trader who would do kind of a combination of, they do very careful analysis and have reasons for putting positions on, But then he would also have these emotional moments, like literally, somebody has a fight with their wife or their kid and comes into the office and says, just sell this. And so, we're moving hundreds of millions of dollars in a thin market, and the market is moving like crazy. Now, if you're at home seeing that and trying to figure out and thinking that there's some significance behind every move, there's no significance. That guy had a fight with his wife and somebody has to push the button to that sort of thing happens all the time. This is the market is a mix of very intelligent, very carefully reasoned influences, and also these random, like, little explosions going off all over. And if you try to figure it out, if you try to make sense of it, I don't think you ever will. And I don't think you'll ever be successful. And I think I see a lot of traders get stuck because they want it to make sense. Where one of my revelations is that it doesn't make sense and it's not going to make sense. And that's okay. There's an irrationality to the market that is kind of at the core of what the market is.
All right, thank you very much. From your remarks, I really like the sentence, nobody has the big picture. It is a great take about the market, and also about being curious and accepting that the market is weird in some ways. These are the takes that we have to take into consideration, also write somewhere, so to never forget them, because we're trying to find the rules here in the market in order to become successful. Now, if you allow me, I would like to talk a little bit about the main aspect or the main challenges that usually traders face, not only traders in Iran, but internationally. You see, like selling every product, there comes the strategy of marketing. And especially in Iran, the way that trading is marketed, it's in a very glamorous way, quick and easy money. And a lot of people fall into this trap. So it's a really big misconception. Why do you think a lot of people fall into the trap of this is an easy market, come to it, you will earn a lot of money?
Well, like you said, it's marketing. And it's one of the things that, I run a business teaching people how to trade, which means that the more people who see my stuff, the better it is for my business. And honestly, the better it is for people, because I can teach people how to trade. But excuse me, the issue is that honest marketing, if I were going to craft a perfectly honest marketing message, here's what I would tell people learning to trade. Okay, so it is possible that you can, with a modest amount of money, you can make a lot of money. You can completely transform your life. You can be completely free of having to go into an office and potentially getting fired. You can really be the master of your own destiny. This is possible. However, so that's where the marketing message usually ends, right? And and then you put helicopters and people in swimming pools looking sexy, and everybody wants to do it, right? But the real message comes after the however. This is a very difficult business. I like to say that, what we actually do when we trade, we push a button and we make or lose money. And so you're actually just moving your finger and it seems pretty easy. I think trading is the hardest easy money that is possible to make. So the majority of people, the vast majority of people who try to trade fail. So that's one thing you need to know. And all of a sudden, the marketing message is not getting so good, right? If I tell you that 9 out of 10 people who try to do this don't have the focus and they don't have the right mindset to be successful, and they're going to fail. Well, that doesn't sell a lot of courses. That doesn't get a lot of people to buy. But that is the truth. And then I will say, if you are able to be successful, if you have the focus, it's going to take you a long time before you're really successful. This is a difficult skill. Now, this is a difficult skill to master. Now, think about it. We're talking about something that can truly transform your life. It makes sense that that's not going to be trivial, right? It's not going to be easy. It's not like, you pick up a lamp and some spirit comes out of it and starts granting you wishes. That's not the way the world works. Anything that can make an appreciable change in our condition takes work, takes effort, and takes time. And trading is certainly like that. The learning curve for trading is at least 3 years.
Wow.
Now, all of a sudden, that's not very exciting marketing either, right? So 9 out of 10 people fail. And if you can do this, it'll probably take you at least 3 years to learn to do it, and sometimes longer. I get messages from people. I got a message a few months ago from somebody who had been following my work through several different places I put it out, had read all my books, had lost consistently for about 10 years. And he says he's not actually sure now, but he's made back all of the money he lost, and he's made more than $1 million. So it took him 10 years. Now, if you could tell somebody that that might be a reasonable path, it's not good marketing. So this is why, the people who are making this, let's say, dishonest, maybe we should say misleading, but I think it's dishonest. People who are making the dishonest marketing, they're not really in the business of your success. They're in the business of selling courses. And if they were in the business of your success, they would tell you things like I have told you. Now, I don't tell you things like that to be, and I would also say, as we got a little bit more deeply into this, that this can be dangerous. You certainly can lose all of your money if you're reckless. So don't be reckless, right? You have to protect yourself. People go through psychological struggles. People have different kinds of breakdowns with trading. People end up having drinking. So all of these things are possible. And I don't tell you this to scare you. I tell you this because so you have some idea of how difficult it's going to be to climb this mountain. And then if you understand what I'm saying, so what happens? You buy that course from that person who promises you quick success. You do a few trades, maybe you make a little bit of money, and then you start losing money. And then you lose a little bit more money. And now what are you thinking? You're thinking one of two things. You're thinking either this doesn't work or I can't do this. I'm a failure. But if you have the message that I just gave you, you say, wait a minute. Okay, so I know this is difficult. I know this takes a long time. I know this is a skill I have to learn and I have to develop. You'll approach it differently and you have a much better chance of success. So I think this is why, it's no mystery, incentives determine outcomes. And the people who are creating marketing are trying to sell a lot of courses. And the way they sell these courses is with somewhat dishonest marketing. However, what I'm interested in, and I know you and I have spoken before this interview, what you and what your firm is interested in is developing traders and helping people to be truly successful at this. So having this correct message, correct alignment, I think really does a lot to make that happen.
Thank you so much for your great answer. I think trading is one of the few professions where beginners assume that they can somehow or outperform the ones who are seasoned in the financial markets, and
Right.
It comes from the misleading marketing that exists. Now, in your remarks, you have also mentioned that it is okay to lose, or to have a strategy that somehow leads not to profits, but to losses. Now, for a lot of traders, for a lot of people who are participating in the financial markets, especially as retail traders, it is a very difficult mindset to accept. Now, how can traders shift their mindset, somehow adapt with this reality that losing is a part of actually winning?
So you have to redefine how you think about losing, how you think about mistakes or errors. And many losing trades are not even mistakes. So this is the first thing you have to do. You have to understand what it is you are supposed to be doing as a trader. So then you can look at what you have done and say, did I make a mistake? Mistakes are bad. If you make a mistake in trading, examples might be, and if you've never traded, what I'm about to say is going to sound absurd, but if you trade a little bit, you'll do this. You'll buy instead of selling, or you'll buy or sell the wrong asset, or you'll buy or sell the wrong quantity. these seem like silly mistakes, but these are the kinds of mistakes that are true errors, and you have to fix those errors and eventually reduce those errors. However, so, think about bad things that happen. For instance, I'm still a musician, and right now I'm working on learning. I don't know if you know the Goldberg Variations by Bach. It's one of the it's a multi-hour-long piece of keyboard music. And what I'm doing with this is I'm working very small sections over and over so I can do it as perfectly as possible with no mistakes. And any mistake that I make there is showing me that something is wrong. My hand's a little bit out of position, my brain's a little bit out of position. So my goal is to be able to completely eliminate mistakes. And of course, we're human and that's not really possible, but that's the goal. Now, with trading, so if you look at a trading record, you're going to see a string of wins and losses, winning trades and losing trades. And those losing trades, if we approach them with the same mindset that I just outlined, say for a professional musician, or for an athlete, or for an airplane pilot, you don't want to miss the runway. These kinds of mistakes are bad. If you approach those losing trades with that mindset, you're going to be completely destroyed as a trader, because what you're actually doing when you trade is there's a big piece of randomness in the market and also in trading outcomes. And it turns out that our brains don't deal very well with random outcomes. We don't have, even for people who are very educated mathematically, this is something that we don't have very good intuition about. We can easily understand consequences. We can easily understand cause and effect, but we don't have the wiring in our brain to intuitively understand, if I have a bag and in this bag there are 10 marbles, and let's just imagine that 5 of those are black, 5 of them are white. And what's the probability if you reach into that bag and you pull out 4 marbles, putting them back in each time, that they're all white? Now you're going to think that, there's no chance that would happen, right? But actually, it turns out if you do the math, it's not that incredibly unlikely. And we could talk about a lot of other ways and places that randomness doesn't really resonate with our minds. But what you're actually doing, excuse me, getting over the flu here. Mostly over, but you may have the occasional cough to edit out. Sorry about that. What you're actually doing is you're reaching into that bag of unknown trade outcomes. And your trading system, your trading approach will determine what is in that bag of uncertainty, as far as the percentage of wins or how big wins are in relation to your losses. And we can talk specifically about this if you want. But the point is that many times you will do absolutely nothing wrong and you will have a losing trade. And it is as much a function of how the market works, how trading works, how probability works, how the universe works as anything. If you internalize each losing trade, like a football player that misses a goal, and you say, oh, this means I'm a bad trader, it will crush your psychology. And it's also very much not how the market works. I know many traders who are successful who win less than half the time. And in fact, some of the very successful ways to trade might win 20% of the time. So imagine that you do 5 trades and on average, only one of those is a winner. And a trader who is used to trading like that accepts losses and just moves on. I have a blog which you may have seen that's titled something like winners live in the land of losers, or something like that. And it's kind of a abstract romp through probability space. One of the mistakes that new traders make is they want these very, very high win ratio systems.
Yes.
So, and it certainly is possible. You can craft a system where your win ratio is you win 90% of the time, but that's not what is really important. Well, and I think we can all agree that the way your trading account is going to be judged is after you do a large number of trades, you're going to look and see if you made or lost money. That's really all that matters. And how you get there. If you put in, I would not suggest this, but if you had a trading system that did 1,000 trades and you had 999 very small losers and then one gigantic winner and you made a ton of money over those 1,000 trades, that would be a successful run for that trading account. Now that's an extreme, and that's that doesn't really make any sense. But the problem is if you go for these very high win ratios, what this will mean is that your wins are much smaller in comparison to your losses. So that's the other piece of this is, what we would call people say risk reward, because at least in English it sounds a little bit better. It really should be reward to risk, which is a little bit harder to say, I guess. But typically what you will see in those very high win ratios is if you have a losing trade, you might lose 4 or 5 times what you win on a winning trade. Now that's okay, and that can work, but it also can lead to a different kind of frustration, because then, I've seen all of this as somebody who trains traders. I've seen people who say, Adam, I'm 85% wins. I've done 500 trades and I'm not making money. Now that's absolutely possible. I've seen that over and over. Why? Well, because their system didn't actually work. The losers are much bigger than the winners, and they had a few cases where they lost control and had a few, it only takes a few real mistakes or, outsized losses to completely destroy an account. So be careful of anything that is, if you detect in your psychology, anything that is kind of designed to push you away from losing. At the same time, the whole reason we're trying to be traders is to win and to make money, right? But the way you get there is by accepting the short-term losses on individual trade outcomes. It's something traders really need to watch for.
Thank you so much for your in-depth answer. So what I take from your answer is that trading is difficult. It has a lot of challenges. It's different from the picture that is advised. It is possible to become successful, but you have to find order among all the randomness that it has. And we talked briefly about successful traders. The reason why people are attracted to this market is because they have heard tales about Warren Buffett, for example, and they have seen maybe among their relatives or their friends about people who have changed their lives as they have walked into the realm of trading. Now, if you look at the most successful traders, they come from different aspects. They have different strategies. They sometimes are scalpers, sometimes they're day traders, sometimes they're even investors, not even traders. Now, but there must be something that they all have in common, something that keeps them in the game. Can you tell me what are some traits of successful market participants and traders?
That's a really good question. And as you said, people are successful in every time frame, from long-term investing to very short-term scalping. One of the things that I have seen over the years is there's just like, there's a real attraction with the sexy marketing to certain kinds of trading. That marketing tends to encourage very short-term trading. Everybody wants to be a scalper. Everybody wants to do 20 trades a day. I have seen and I've done that. I have been a trader who has done hundreds of trades in a single day. So I've done that. I've seen in my own records and in the results of many, many other traders, and also in like heavily quantitative institutional traders, that most traders do a little bit better on longer time frames. So one of the things, if somebody is struggling here, you're a scalper and it's just not clicking, go to a little bit longer time frame. Go to maybe try hourly charts. If you're trading those hourly charts and they're not working, step out to the daily time frame. And I know this flies against a lot of the marketing, but the reality is that in those trades that we hold for, say, a few days to even sometimes a few weeks, I think there's an objective edge there that there really is not on the shorter time frame. So one of the, while, again, people are successful across, across the spectrum of time frames, I think that many struggling traders will find better success on that daily time frame. Now, having said that, what do the people have in common? Well, they keep good records. So it is very, very easy to lie to yourself when you're trading. And I don't mean that in any, it's not like you're trying to do anything nefarious, but I've had traders come to me and say, help me in my trading. I'm doing everything right. We talk about what they're doing, and second, well, let me see your trade record. Well, I don't really keep a good journal. I don't keep good records. Okay, so start doing that. So, and then once they do that, what they discover very quickly in a few weeks is they don't need me, because they're not doing the things that they told me they were doing. If they were doing those things, they'd be successful. But when they actually look at their records and they keep good records, they see they're not actually doing those things. So people this is ultimately a numbers business. And, my approach to reading markets is a little bit intuitive. It is a little bit, pattern based, but still, the accounting matters. Keeping good records matters. That's incredibly important. People also are resilient, meaning that, we just talked about accepting individual trades. Okay, that's normal. But one of the other, and I kind of hinted at this with the marble example, but one of the other aspects of randomness is you'll have unexpected runs. You'll have many more successes and many more losses in a row than you would expect. So what this means practically for a trader is that you will have periods where you make a lot of money, and then you'll have periods where you lose a lot of money consistently, even when you're doing the right thing. And this is really difficult. This is called drawdown. And the reality is that your trading account is going to exist in drawdown most of the time. The time that your trading account will make a new high and then we'll pull back, maybe not very much, but you're not actually at that equity high in a trading account all that often. You'll spend most of your time in some kind of drawdown. And that can be very challenging. That can encourage somebody to start doubting everything they're doing. That can encourage somebody to start experimenting with different strategies. If let's say you've been very successful on the daily time frame, and then you hit a drawdown, what your brain will say is, oh, maybe we should be a scalper, which of course makes no sense. It's something completely different. You're training for a completely different game, but the brain says, oh, that makes sense. Let's do that. So the people who are successful have resilience. They have the ability to stick with their approach even when it gets challenging. And beyond that, one of the things that's maybe even most surprising to me is to see the complete spectrum of personalities that work. If you say, what's the right personality for trading, there really isn't a right person. There's a wrong personality, and I can tell you about that. But the wrong personality is somebody who is very neurotic and very worried, who also has very low attention to detail. If you have those two personality traits that align, if you're somebody who thinks about everything that can go wrong, who is always very nervous, and you just can't be bothered to look at things in detail, you're probably not going to be successful in this business. Now, if you were really motivated to trade, you could probably do some work on yourself. You could probably build systems that could overcome some of those challenges. But that personality type, which is not extremely common, but if any struggling trader recognizes that in himself or herself, it does set up other difficulties, and it's something you need to be aware of. Beyond that, everybody from the super masculine attack, very aggressive. I've worked with traders, and there was even a time in my career when I've smashed a number of telephones and keyboards and monitors, and it's not a very productive way to live. And then, on the other extreme, you have people who have this monk emotional, nothing can disturb them. The building can catch on fire and they're just going to calmly walk out of the building and everything's okay. All of those personalities work. Very mathematical personalities work. Very artistic personalities work. And I think a lot of people spend a lot of time asking if, do I have the right personality for trading? And this is something I don't think is said enough, that you probably do. If you're a little neurotic, then there's something you probably need to address there. But it's surprising if you look at the range of people, and also, the backgrounds. The people who I have seen be very successful come from highly educated backgrounds or almost no education at all. There certainly is a kind of intelligence that's required in the market, but I think as much as anything, it's I think of it as kind of enhanced common sense. Now, of course, this isn't true if you want to trade a very mathematical strategy. Then you need, and I've worked with traders and I've helped them develop strategies where those traders have mathematical backgrounds that far exceed mine, and I don't even understand some of the work they're doing. But it's certainly not the only way to do it, and people do find success from many different backgrounds.
All right, thank you very much. That's a great intake, and it makes a lot of sense. Now, something else that I really want to focus on here is that you mentioned in your speech is that you need to find a strategy or a way that helps you become profitable or successful. Now, people try to hop on different strategies. Now, something that happens is that as you somehow change the way that you see the market or change the way that you are active in the market, it somehow makes everything more difficult. There is no consistency in what you do. And it somehow stops you from being profitable. In other ways, it comes from somehow adapting to the market situation. Right. Now, if you choose, for example, one part of being active in the financial markets, for example, if I say, I always want to be a scalper, is that a better mindset to always stick to one thing? Or is it a better mindset to try to explore different aspects of the financial market? Which one do you think is better? Should you stick to one thing, or should you try to change the areas or be active in different areas in order to see what fits you best?
So it's a good question, and I think the answer to that is going to be a little bit frustrating because I think the answer is both. I think so many traders who struggle at the beginning struggle because they're doing things that don't have an edge. And this is, in fact, many of the common technical tools that people talk about, I've done a lot of statistical testing. It's one of the things that makes my work a little bit different. I'm a discretionary trader, but behind that is decades of heavy-duty statistics. And if you look at a lot of the tools that people talk about, that indicators, for instance, that people put on screens, RSI or ADX. They actually, RSI is one that does have a statistical edge. They don't have the edge that people think they have. And so right away, people are using tools that don't give them an edge over the market. And when I say an edge, I just mean a reason for placing a trade, meaning that if you have your trading system and you do a meaningful number of trades, you're more likely to make than to lose money over that set of trades. It's simple. We can get a lot more detailed with it, but that's the idea of a trading edge. And so it would be a mistake, no matter if you're doing something that does not have a statistical edge. You could spend 4 years doing it with perfect discipline and you're probably not going to make money. So it's very important that the trader have something that fits their personality. And what does that mean? That's that we probably could talk for hours about that. But I would say that means in terms of activity and risk and maybe even the asset that you trade. Some people want to trade currencies or commodities or stocks for different reasons. And again, here the caveat is that a lot of new traders are brought to the market looking for excitement. And so this is why it's another reason why they gravitate to that shorter end of the time frame, which shorter time frames, which are objectively the edges are thinner there. So I think a developing trader needs to find that system that has an edge that fits his or her personality. And you can't do that at the beginning except by exploring. However, you can't be changing what you're doing every 3 days. And you're probably not going to make money in this phase. This is something where having a community can be very helpful, having other traders who are having some degree of success, having a mentor can be life-changing here. Once you have found something that clicks, I think it then makes sense to develop consistency. One of my mentors described trading as his analogy was a mason building a brick wall. And he said it's not very exciting, right? You put down a brick, you put the mortar on it, you smooth it, you put down another brick, and that's all you do every day. And so again, people are drawn to the market because they want excitement. They want something that is about solving the market puzzle. And turns out consistency is not very exciting until, of course, you go buy things with the money you've made from consistency, and then it's a different kind of exciting. However, once there is also the danger of stagnation. And once you have found success, once you've made significant money, you need to know your personality. I know traders who do one thing and they do it well, and they've done it for decades and they made a lot of money doing it. That absolutely is possible. Somebody like me who's a little bit more scattered, then you're going to be drawn to explore different time frames and to see how you can challenge yourself to kind of see what you don't know. But I guess what I would say about that is emphatically every transition, I hinted at this earlier, I've made, whether it's to a different time frame, a different asset class, the first thing I did was I lost, and I felt like I had to relearn a lot of what I knew about trading over again. So, it certainly is a challenge. And the reason for this is, I think, that the psychology, if you consider scalping versus this daily time frame that I'm talking about, the psychology is completely different. Scalper gets into a trade, and the instant that trade in a fraction of a second doesn't look right, the right thing to do is probably to get out of the trade. On the other hand, on that daily time frame, the right answer more often than not is to give it a little bit more time. And a little bit more time might mean a day. So, you go from somebody who's used to making a decision in a second, and then you're asking them to wait a day to make a decision. It's such a different cognitive load that it's a complete relearning and rewiring. So it's a good question, and I'm sorry it's not a better answer, but I think the real answer is both.
That's a great answer. Thank you so much. Now, another thing that I have to point out, as we are mainly focusing on Persian-speaking traders in Persian-speaking communities, is that we are always looking for a golden formula. You call it somehow an edge. We call it a setup, something that helps us be successful. Do you think this ideology that we have, that we need to find a setup that is profitable most of the times? As you mentioned already, it is somehow possible to have a high win rate, but trying to come up with that strategy, having that edge all the time, and somehow this idea or this fantasy consuming you, do you think that's healthy, or it's actually the way to go, trying to find that golden formula or this strategy that is most of the time successful?
So I think there are two different ways to think about this. As an English speaker in a Christian country, the parallel that we would use is the Holy Grail. You know, we have the King Arthur stories of looking for the Holy Grail, and that's the phrase that an English-speaking trader would use. That I'm looking for the Holy Grail. Now, if I find the Holy Grail, the expectation would be it would be a strategy that would maybe like almost never lose. It would be guaranteed profits. It would be very easy to apply, and it would make a lot of money. I don't think that exists. So I don't think that I don't think that the Holy Grail or the golden formula or in anything, because think about what the market is. The market, and this is true of whatever market we're talking about, whether we're talking about currencies or commodities, and they're a little bit different, right? Or
Sure.
stocks and equities, they exist for different reasons, and some of these markets cultivate insider trading, which is a big thing in America. Insider trading in stocks is very illegal. If I know something about what's happening in a company, and if I make trades in that company's stock based on that information, I will go to jail very reliably. They prosecute that pretty well. However, if I am a corn farmer or soybean farmer, and I know secret things about what the harvest is going to be, not only can I trade on that, I have to trade on that. So if I go into these markets, I'm facing different influences. In the currency markets, there are big amounts of money being moved around at different times for different reasons. And all of these markets have these different influences, but they don't exist so that we can trade them and make money. That's one of the core revelations. It's obvious, right? The market does not exist so that you or I can go into that market and make money. It exists for other reasons. So the market is, the academic word we use is efficient. What in a perfectly efficient market, all information that's out there would be correctly priced instantly, and there would be no way to make money in the market, because everything anybody knows would, and the markets are not perfectly efficient. I will tell you that. The academic idea, if it were true, there would have to be like almost some magical formula that every piece of information moves the price and it's always the correct price. That's not the reality, but the reality is much closer to that than we wish. The market is extremely competitive. Whatever edge you can find in the market, it's going to be small. If it were, I'll give you an example. I found many years ago, when I was not so smart, I was less smart than I am now, let's say, I found a way to make money by some companies the same company will issue two different kinds of stock. And the stock will have like different voting rights. That's one way they're typically different. So there should be a small difference in the price of those of those two stocks. Now, keep in mind, it's the same company. And what happens is if you look in the market, you'll see you can calculate what that theoretical difference should be. And then you go and you look at the market and it's different. What you actually see in the market is different. And so you say, oh, wait, I know what this number should be. This looks to me like an arbitrage opportunity. Arbitrage does exist, but it's extremely rare, and the retail trader is probably not going to find arbitrage. But what I found was even with trading very, very small amounts of money, when I would go to take advantage of this difference in prices, I would push the prices into the correct relationship there. And there was basically no money to be made. It looked like there was free money there, but as soon as I executed the trade, it went away. And this is, whatever system you think you have found, whether it's some kind of breakout or some kind of mean reversion or some kind of continuation or some kind of volatility change, it's a thin edge, which means it's not going to be a holy grail. It's not going to be a golden formula. What it is going to be is, at best, something that gives you a little bit of an advantage over a large sample size. Now, that's the other key to having an edge in the market. It's only valid if we look at a number of trades, because on any trade, this is one thing that's difficult about trading. You could not take a random person and with no training, put them in the cockpit of an airliner and say, land this plane. I think if you run that experiment 10,000 times, you're going to have 10,000 fireballs. You could not take a random person and give them a scalpel and say, here, do this open heart surgery. You've had no training. Good luck. Patient's going to die every time. However, you could take a random person off the street, put them in front of a trading platform and say, push this button, and that person could make $1 million on their first trade.
Beginner's luck.
Absolutely possible. Yeah, beginner's luck, or even just kind of, you're pulling those random draws out, and maybe they get lucky at the beginning. And there does seem to be a little bit of beginner's luck too. That is something that turns out, I think, aligns to make our lives a little bit difficult. Beginner's luck makes the rest of the curve more difficult. But the idea that anything can happen on any one trade is that this is another aspect of randomness that we don't understand. If somebody develops a very good system, I've seen people, I have a very intensive training program where people go through and do all of these like fundamental level lessons to develop their own intuition around probability, and then they develop a back-tested system. They understand patterns, and then they forward test it. So by this time they're writing up all these very detailed trade plans around this. By the time you get to this, you've invested months on this strategy, and then you go and you do, and your first 2 trades are losers. I've had people do all that work and say, I guess it doesn't work. Well, what do you mean? So in the course of your study and backtest, you've looked at thousands of trades, and you now have 2 trades, and they happen to be losers. And you also know that the probability of that happening is, depending on your system, maybe like 25% of the time that's going to happen, like, no big deal. But still, there's that intuition. So it really is a bit of a contradiction to understand that anything's possible in any one trade, and a lot of psychological issues kind of swirl around that fact.
Thank you so much for that insight. It aligns well with the point that I will try to make right now. So with the randomness of the financial markets, I mean, as I mentioned, and as you have mentioned beautifully, with the randomness, there are some ways that you can find order and you can find ways to become successful. But as random as the market gets, our emotions get really random as well. I mean, we will be overcome with fear or greed or the curse of being over optimistic that every trade that I put is going to be successful. Now, how can I somehow build a mindset that helps me recognize these type of feelings? Because sometimes you don't understand that the actions that you're taking are charged with different types of toxic emotions, like extreme fear or extreme optimism or extreme greed. How can I, as a market participant, identify these types of emotions and somehow set rules for myself so that I stay aligned?
So one of the things that I think is maybe not appreciated enough, if you look at the literature and what even academics have looked at with the way the market moves, the market encodes human emotion. The movements of the market, as you said, certainly have a huge component of randomness, but there are all of these influences that go into moving the market. There are certainly these movements toward correct fundamental valuations, but then there are these emotional reactions, and we see these around big economic announcements, around surprises when some world leader does something crazy, unexpected, and for the time being, it looks like it's probably going to be the world leader of my country who's going to be doing that. And the markets have these crazy reactions. So what I don't think people appreciate enough is the market's movements encode that human emotion, but they also provoke emotion in traders. And it turns out, if you sit down in front of a trading screen and you acclimate to the way the market moves, your natural reaction is going to be to do the wrong thing at the wrong time with astounding regularity. In fact, I know traders. This is a horrible and extremely dishonest thing to do, but I know trading firms that hire new traders, give them trading accounts, and then do the reverse of that. They train the trader knowing they're going to lose, and then they do the reverse of that trader's trades on big size.
And it's profitable.
So it's profitable. It's probably one of the more certain ways to profits. And if you understand that, then you can understand a lot of the businesses with the prop firms that are out there, and see that okay, so maybe there are some things there. So I have thought for years that one of the big challenges with trading is that the market takes our carefully crafted self-awareness and self-control and turns it around, like taking a spear from an old Greek soldier and turn it around so the point is directly toward his chest. That's what the market does with all of our intelligence, all of our emotional control. And this is incredibly frustrating, because the strategies that have served you well in life and many times in careers, many people who come to trading, they've had successful careers as doctors or architects or engineers. And then when they try to trade, they discover that everything that has worked in my entire life does not work for me in trading. And more often than not, they just decide they can't trade and they move on. But what's actually happening is the market has this almost perversion of emotion that will cause you to do the wrong thing at the wrong time. So if you know that, then what you have to do is you have to develop a little bit of an abnormal approach to managing your emotions in the market. And you're never going to get rid of emotions. This is a mistake, to think that, and people certainly think this. Okay, well, if this presentation cut off right now, people will go away and they would say, well, Adam said that my emotions are going to hurt me in the market, so I'm going to eliminate my emotions. I'm just going to be
a robot.
completely rational, right? A robot, or just to have no emotion. It's not possible, because as humans, our decisions are a mix of rational analysis and emotion, and maybe some intuition and maybe some other stuff. I don't know. It's a separate discussion, but the goal is to be aware of your emotions and to not let them affect you. So, basically, what you're going to do as a beginning trader, when I told you about my first trades where I had extreme emotional reactions, what you're going to do is you're going to react based on those emotions, and you're going to lose money. As you become a little bit more experienced, you're going to hear that emotional self saying, I'm worried, I'm worried, I'm worried, I'm worried. And you're going to have the control to say, okay, I hear you, but you're just an annoying child. I'm going to ignore you. So that emotion is always there. And I think, at some point after you do a lot of trades, a few hundred, a few thousand trades, the emotional charge does become less.
Sure.
But other things, you as a trader, life is up and down, and you may have other things happen in your life that affect your trading and affect your emotional balance. But the goal is not to eliminate emotion. It's to be aware of your emotion and then not to be overly influenced by your emotion. And some people get to the point where there are traders who don't really have that much of a system, except that they can trade against their emotional reactions. And they can say, my inclination here is to buy, and that must be wrong, so I'm going to sell effectively. Now, having said that, again, back to the setup idea, I do think it's essential to have, in my opinion, to have an approach in the market that you can replicate. So we're not talking about the Holy Grail, but we're talking about something where you can build consistency. And this can be discretionary. And this is, the people who trade with computer systems will look at a discretionary trader and they'll say, well, you're not really systematic, because if I present you with the exact same information 10 times, my computer system is going to make the same trade 10 times. You're not as a human. And I'll acknowledge that's true, but I know that I'm probably going to make the same trade 8 or 9 times. It's not going to be 100% consistent, but because, I'm factoring other things in. What you want to do is you want to be able to express your approach in a fairly concise set of conditions, that when I see this, this, and this, I will make a trade. If the market goes here, I'm wrong, I will get out. There's where my stop is. If the market goes here, I will get out with a profit. That's my profit target. Maybe you have multiple entries. Maybe you have multiple exits. Maybe you won't have a profit target. You'll trail a stop. Whatever. There are a lot of different ways to do this, but I do think it's, back in our Holy Grail discussion, it is important that you have an approach, a methodology, a system, call it what you will, an approach that is consistent. And there are some things that don't change. And, and you hinted nicely at this. I would look at what the market does around big moves in particular. That's kind of a clue. There are some more. If we assume that when the market just kind of like normally chopping around, it's mostly random. If that's true, when the market makes a bigger move, then that's probably less likely to be random. It could be, I guess.
Yeah.
You don't really know. But what's probably happened is new information has come in the market, or big money is making a decision for some reason. And those kinds of moves, maybe it's a single bar, maybe it's a number of bars, and this is why I find tools like Keltner channels that show when a market has made a big move on a more extended time frame. Those can highlight some trading opportunities. And while I firmly believe that the market changes, and this is one reason why trading is so difficult, we change, the market changes, there are aspects of market behavior that are absolutely unchanged. And the core of my approach, I'll tell you what I found works for me, is to wait for a market to make a big move. And then there's some refinement with this, there's pattern recognition that goes into it, because there is a kind of big move that's quickly reversed. And that's, people do trade like that. You're trading mean reversion, but you have a big move and then the market kind of hangs out there and makes a little bit of a pullback. and then another move in the same direction. That has been one of the most repeatable, one of the most consistent approaches to trading I found across time frames and asset classes. And a while back, I got interested in saying, okay, what happens if we look at different kinds of markets? So we went and looked at stocks before the electronic markets, and this still worked. In the, even in the late 1800s, when we have stock data, it still worked. We got commodity prices from the Middle Ages, looking at like barley prices in Europe in the 1300s, and saw evidence that this approach, this is something, I'm telling you this because this illustrates, I think, how fundamental this approach is. The market makes a big move and then doesn't really give up that big move. Chances are there's a further move in the same direction. It's not difficult to explain or to understand. It is difficult to quantify and to trade. And then the really interesting thing was, here, you can, if this is too weird, you can edit it out. But we looked at price records from antiquity. It turns out that some of the earliest writing we have, the clay tablets with the cuneiform, like the Phoenicians used, were actually price records. It was merchants recording prices. That might have been one of the reasons people started writing. And those price records were quite different. They, of course, they didn't draw bars. They didn't even record prices every day. But what they did record was they would wait for a big price change, which is a pretty, if your writing material is precious, and you might say it doesn't make sense to write down the small changes, you wait for a big change, and they would put dates on those. And we were able to look at the price of commodities that were traded in deep antiquity, dates and barley and things like that, and to find these same principles that we apply in electronic markets today. So I think this is a fundamental aspect of human psychology and market behavior.
Thank you so much for that answer, and it was very interesting. So if I had to somehow repeat what you said, is that I heard a few keywords that could help us somehow navigate our moves in the financial market: consistency, acceptance, repetition, replicating. So I think these words could be the keywords that help us create a realm for ourselves in the financial markets to be somehow successful. But we have to be mindful that the way that being successful is advertised is not always going to be true. So if you allow me, I just want to point out this thing, is that we say stay consistent with the market, because history repeats itself, and we can somehow find patterns and somehow find ways in order to become successful or profitable. That's basically, I think, the philosophy of technical analysis, is that the history of the price repeats itself. You find the patterns and you do a trade. But in another way, we say that no, because the market is always changing, it's random, you have to adapt. Don't you think there is somehow a dilemma? Which one is better? Should I be like consistent, or should I always change myself and shapeshift?
Well, there's an apparent contradiction there, but I don't think there's actually a contradiction. So let me make some tiny refinements to what you said. So I don't think history repeats itself. I think maybe a more accurate way to say it would be that history rhymes. So you see similar, but you can't expect it to be exact. And you can't expect because the people, even if you had the exact same conditions, the people in the market at any given time are a little bit different, and what's happening in related markets is probably different. So you will have very similar similarities, but I would not expect exact repetition. Similarly, the idea that markets are random. I think a more accurate way to say it is that market movements have a big random component. And, again, randomness is a fascinating topic. We could have a mathematical discussion for hours and hours about this. And it does kind of cross into philosophy, because even, the way you look at randomness statistically, there's no test where you can say something is definitively random. And I have, I'm looking here on my desk, and I have a couple like hardware random number generators. We do a lot of work with randomness, but what you're always doing with randomness is you look for tests that show it's probably not random. And if you can't find those, you assume it's random. It's kind of a process of elimination. And there are a lot of people who will tell you markets are not random because people make decisions for real reasons. So there, and you can look, I've had some fascinating discussions online with people who are kind of misled mathematically, I think. But at the end of the day, a lot of the market's motion looks random. A lot, not all. History rhymes, does not repeat exactly. So what you do with this is, I think in the extreme, you proposed either being a shapeshifter and changing constantly, or being utterly consistent. I think either of those extremes will lose, because if you're an extreme shapeshifter and there's no consistency with what you're doing, how are we going to evaluate your results? What confidence can you have? This is this from the beginning. When I was trading, I wasn't so interested in making a lot of money. I wanted some hope, at least, I guess, but some reason to believe that I would be able to make money 10, 20 years from now, and that I'd be able to make consistent money. And if you are just randomly, essentially, I would not say random, but if you're changing what you're doing all the time, it's no consistency. You can't evaluate it, and you can't tell me there's any chance you're going to be profitable next year. On the other hand, if you find a book from the 1950s that gives a trading system, and you try to do that exact system today, and it's not profitable, and you continue to try to do the exact system because it's in a book from the 1950s, that's not going to work either. So what I think you have to do, and it's not, at some aspect of in some point of the trader's career, like the whole the whole secret is here. It's finding out when to adapt and how much to adapt. And if you are if you're a system trader, what I mean by systems trader is somebody who writes computer code and then the computer executes the code. What those systems traders will find is, and people all would say algorithmic, or bots, or other things that people say, what you would find is that those systems work if they work, but they'll stop working, and then you'll need to make little tweaks. You'll need to make little adjustments. As a discretionary trader, I would tell you, if we were just casually talking, I would tell you that I trade the same way I traded in the year 2002, and I haven't changed the way I trade. I believe that to be true. However, if I very carefully look at my records, I see it's not true. I've made small adjustments. I'm putting my stops in different places. I'm changing how I'm taking targets. I'm taking different kinds of entries. I've eliminated different kinds of entries. So I've made what to me seem to be, as a discretionary trader, almost imperceptible changes. And I've been responding to my own record keeping and to what I see working and happening in the market, where the systematic trader is very aware of the issue, because they had to pull the computer program out of production, is what you call it when it's actually trading. They had to pull it out of production. They had to change the inputs, or maybe even change the code. Where, as a discretionary trader, I didn't know that I did that unless I'm watching very, very carefully. So the answer is, if I had to choose one of those mistakes, the answer is probably to be more on the consistent side. But there definitely does need to be some adaptation, and many new traders fight against the discipline of quantifying and structuring their approach. They want to be that, I'm just going to push the button now because it looks good. But even what I would want to throw out there is, even if you've made money, there's no guarantee you're going to make money next month, and that's what we're really interested in.
All right, thank you so much. Thank you for your great response. Now, as we are approaching the end of this interview, I just want to ask this question. You see, in Iran's market specifically, trading psychology is either underestimated or overestimated with different somehow financial market gurus. Now, a lot of people believe that if you decode the psychology of the market, you have a high chance of being profitable. Now, what do you think? Is market psychology more important, or actually that edge that we talked about and the system that we talk about? Which one do you think has more value here?
Okay, so I'm going to build an airplane for you. Which is more important? Do you want wings or an engine or landing gear?
All of them.
Right. And that's the answer. It is completely possible to have a system that has a good edge and to be unable, because of psychology, to be unable to do what the system asks you to do. And I've seen traders develop systems that go against their psychology and personality, and they could not use those systems. They had to throw them out, give them to somebody else, and develop something else. So you have to have psychology. On the other hand, what actually works in the market is pretty counterintuitive. So if you just go in the market aligned with psychology, I've never seen, in the many thousands of traders I've interacted with, I've never seen somebody trade successfully purely on psychology. You need both. And the thing that is challenging for developing traders, people say trading is 95% psychology. Well, at some point in the process, it might be. It might be 100% psychology. I have a trader that I'm working with now who I think has all of the pieces, except he's just unable to execute. And for that person, it's 100% psychology right now. But that's only after a lot of system development, a lot of quantitative work to get there. At different points in your career, different aspects are going to be important. And I think that it's a mistake to say it's all psychology. It's also a mistake to say, many people, like from, particularly an engineering mindset, they'll say, well, psychology doesn't matter. I'm just going to find the right thing to do and do the right thing. Okay, well, you come back in a few months and tell me, they'll discover, okay, psychology is a lot more important than they thought. So the answer is both.
Thank you so much. This has been incredibly insightful. I'm sure all the people who are watching this interview enjoy it as much as I did. Now, if you could just give the viewers, people who are facing challenges on a daily basis as they're working in the financial markets, if you could only give one piece of advice to them, what would it be?
One piece of advice. You're asking me to give one piece of advice that will be universally applicable to all traders. I would say strive for consistency. Strive for consistency in a highly random and highly variable environment.
Thank you so much. So the key word today would be consistency. Thank you. Are there any points that we did not cover throughout this discussion that you would like to share with the audience?
No, your questions were great. I think you did a great job of directing this. In thinking about this, there's always going to be things that we probably should have gone into more deeply, and maybe your viewers will have some questions. Maybe I said some things that were nonsensical that will need to be refined, and we can explore these in the future. But I think we covered everything. It's not a topic that is really easy to flowchart and to work through in a completely logical way, and the reason is because trading success is such an interconnected web of factors and influences. And psychology does thread through that, as does random influences from the market, as does the quantitative realities of the market. But I think you did a good job of structuring a rational look at something, at an aspect of trading that in many cases is extremely irrational.
Thank you so much for being here with us. Now, where can our audience follow your work, and do you have any upcoming projects or content that you're sharing with your international audiences?
So my blog, adamhgrimes.com, is kind of a good hub. There are articles there going back more than 10 years on aspects of trading. If you have, if there's some indicator, or it's been very well indexed by Google. So if there's something that you're wondering, what does Adam think about RSI or pullbacks or support and resistance, you can Google that and my name, Adam Grimes, and Google many times does a really good job of, other search engines too, will point you to good sources there. I also have a huge and completely free trading course, which you can access at marketlife.com. It is as far as I know, it's really the only course out there that looks at technical analysis with an almost academic rigor, which means it's not for everybody. It's going to ask you to do a lot of kind of deep thinking about factors. But if you can get through that, I think you will place your understanding of technical analysis in the top percent of 1% of wannabe traders. Also, my books, the first book, The Art and Science of Technical Analysis, and then you can Google, I did a set of talks called the Hudson Sessions, which are only, I don't know if you ran into those in your research, but they're only about halfway done. I'm going through each chapter of that book, and some of these, honestly, these are big sprawling presentations. There are some that are 3 hours where I really dig into how my thinking has changed over the course of a decade, which, spoiler alert, the answer is in most cases not very much, but also looking at a lot of other influences. I've done a lot of work in recent years in really trying to understand the nature of consciousness through a lens of Jungian psychology, and some of that finds its way into the Hudson Sessions. So if somebody really wants to dig deeply into some of these topics, I think those would be good resources. I'm also on Twitter. I don't tweet a lot, or X now, Adam H. Grimes. You can find me on Facebook. That Instagram, that's kind of my Adam H. Grimes is sort of my handle across all social media. So welcome interactions there.
All right, thank you so much. We'll make sure to put all the links in the description of this webinar, and also the video once it goes on YouTube. Thank you so much for being here. I certainly learned a lot from you and enjoyed this conversation, and I'm sure all the viewers will enjoy it as well. Thank you so much, and have a great day ahead.
Thank you.